Many people buying life insurance have no idea they're comparing two products that were never designed to compete with each other. One was built for the beginning of your financial life. The other was built for the end. And when families try to choose between them without understanding that, they almost always get it wrong. In the next few minutes, I'm going to break down exactly what final expense versus term life insurance really means, who each product is designed for, and how to know which one fits where you are right now. I'm Sean Matteson. I've been a licensed insurance agent since 2006, and I've spent nearly 2 decades helping families make sense of these decisions. Let's get into it. Before we compare anything, we need to agree on something foundational. The reason these two products exist is not the same reason. Life insurance products are built around a specific financial problem they're designed to solve. Term life insurance was built to solve one problem. Final expense insurance was built to solve a different one. And when you try to compare them without understanding that distinction first, you end up making decisions based on price or face amount alone, which almost always leads to the wrong choice. Think of it this way: a pickup truck and a sports car are both vehicles. They both have four wheels and an engine, but you wouldn't use the same criteria to choose between them. You'd start by asking, what do I actually need this vehicle to do? The same logic applies here. So before we get to comparisons or recommendations, we're going to spend a few minutes making sure you understand what each of these products was actually built for. Once that's clear, the rest of this conversation is going to make a lot more sense. Term life insurance is one of the most straightforward financial products ever created. You pay a premium, you're covered for a set period of time, usually 10, 20, or 30 years. If you pass away during that period, your beneficiaries receive the full death benefit. If the term ends and you're still alive, the coverage ends as well. That's the basic structure. And that structure is intentional. Term was designed to solve a specific time-limited financial problem, protecting your family's income during the years when they depend on it the most. If you have a mortgage, young children, a spouse who relies on your income, or significant debt, term life insurance is the product that was built for that season of life. It replaces your income if you're gone before the financial picture changes. The reason term is often the least expensive form of insurance, particularly for younger, healthier applicants, is because statistically most people outlive their term. The insurance company is taking on a defined window of risk, and you're paying for coverage during that window. That's a fair exchange when the risk you're trying to cover is also time limited. What term is not designed to do is provide lifelong coverage, build cash value, or guarantee that coverage will be available when you're older and potentially less healthy. It was never built for that. And expecting it to do those things leads to some of those most common planning mistakes I see families make. Final expense insurance, sometimes called burial insurance or simplified issue whole life, is built around a completely different problem. Not income replacement during your working years, but certainty at the end of life, specifically making sure the costs associated with your passing don't fall on the people you love. The average funeral in the United States today costs between $8,000 and $12,000, and that number has been rising steadily for years. And in burial costs, a headstone, travel for family members, and the miscellaneous expenses that accompany any death, and the real number is often higher than families expect. Final expense insurance exists to cover those costs cleanly without forcing a grieving family to scramble financially during one of the hardest moments they'll ever face. Final expense policies are typically smaller face amounts, often $5,000 to $30,000, and they're designed to be permanent. Unlike term, these policies don't expire after 20 years. They stay in force for your lifetime as long as premiums are paid. And because they're issued through a simplified underwriting process, they're often available to people who can no longer qualify for traditional life insurance due to age or health. This is the product that was designed for a different stage of life, not the accumulation years, not the income protection years, the legacy years. When the goal shifts from protecting your earnings to protecting your family from financial disruption at the end. Now that we understand what each product was built to do, let's look at how they actually differ across the factors that matter most to families making this decision. Term life is temporary coverage. Final expense is permanent. That's the most fundamental distinction. Term has an end date. Final expense, structured as whole life, does not, provided premiums are maintained. Face amounts are dramatically different. Term policies are often purchased in amounts of $200,000, $500,000, $1 million, or more because they're designed to replace income. Final expense policies typically range from $5,000 to $30,000 because they're designed to cover specific end-of-life costs, not replace a working income. Underwriting works differently as well. Term insurance typically requires a medical exam or detailed health history. Final expense policies are usually issued based on a simplified questionnaire, which makes them accessible to people in their 60s, 70s, or even 80s who would not qualify for traditional coverage. Neither product is superior. They serve different populations at different times. Understanding where you are in that timeline is where the real planning begins. Here's where most of the confusion in this conversation comes from. People see term and final expense side by side. They look at cost per dollar of coverage and they conclude that one is a better deal than the other. But that comparison only makes sense if both products are being considered for the same job by the same person at the same stage of life. And they almost never are. Comparing term and final expense directly is a little like comparing a 30-year mortgage to a home equity line of credit and asking which one is better. The answer is, it depends entirely on what you're trying to accomplish, where you are financially, and what options are actually available to you right now. The right question is, what financial problem am I actually trying to solve, and which product was built to solve it? Once you answer that honestly, the comparison usually resolves itself. Here's a simple way to think about these two products and how they fit into a family's financial life over time. In your 30s and 40s, the core financial risk you're managing is income dependency. Your family depends on your paycheck. You may have a mortgage, children in school, and a spouse whose financial security is tied directly to your continued ability to earn. The event that would financially devastate your family is your premature death before you've had time to build assets. Term insurance was built for exactly this season. As you move into your 50s and 60s, the picture starts to shift. The mortgage may be paid off or close to it. Children have grown. The financial dependency that made $1 million term policy essential is either smaller or gone. But a new concern is emerging. What happens to my family at the end of my life? Final expense insurance was built for this reason. These aren't opposing products fighting for the same dollar. For most families, they're equal solutions. The challenge is that many people reach the final expense stage without a plan because they assume their term policy would always be there, and it's not. Let's get practical. One of the most useful things I can do in a conversation like this is give you a clear framework for thinking about where you are and what that means for your coverage decisions. There's no universal answer. Age matters, health matters, income matters, family situation matters. But there are some general patterns that hold true for most people, and understanding those patterns gives you a starting point for your own planning, even before you speak with an agent. The next few slides are going to walk through three scenarios: the case for term, the case for final expense, and the situations where both have a role to play. I want you to see yourself in one of these because that's where the real conversation starts. Term life makes the most sense when your primary financial concern is income replacement during a defined period of dependency. If you have young children at home, term is almost always the foundation of any sound life insurance plan. The financial impact of losing a parent's income during a child's formative years is severe and long-lasting. A term policy that covers those years is one of the most responsible financial decisions a family can make. If you have a mortgage, a business loan, or significant debt that a surviving spouse could not service alone, term creates a safety net that protects them from having to sell assets or change their lifestyle dramatically in the middle of grief. The honest caveat here is this: term works best when you're young enough and healthy enough to qualify at favorable rates, and when you have a plan for what comes after the term ends. If you want to see how this applies to your specific situation, text FEX to 702 605 6038, and I will follow up with you personally. There is a phase of life where both products have a role to play, and it's more common than people realize. Consider a couple in their early 50s. Their youngest child is still in college. They still have 10 years left on the mortgage. One spouse earns significantly more than the other. In this situation, the income protection argument for term still holds, but at the same time, the window for securing affordable final expense coverage is open right now, while health is still favorable and premiums are still manageable. Waiting until the term expires to think about final expense carries a real risk. Health conditions that are minor today can become underwriting obstacles in 5 or 10 years. The premium you lock in on a final expense policy at 55 will be meaningfully lower than what you'd pay at 65 for the same coverage. Working with an experienced independent agent during this window is critical, because knowing when to recommend both and how to structure them so the premiums are sustainable is a skill that takes years and thousands of client conversations to develop. This is one of the most important things I cover in any conversation about life insurance, and it's something I've watched catch families completely off guard. A 20-year term policy purchased at age 40 expires at age 60. And at 60, three things have changed dramatically. You're older, your health has likely changed, and the premiums for new coverage, if you can qualify at all, are significantly higher. Many people operate under the assumption that they'll simply get another life insurance policy when their term expires. But far too often, people arrive at that renewal window to find that the rates are unaffordable. The coverage amounts are limited, or a health condition that develops during the term has made traditional underwriting difficult or impossible. The trap isn't the term policy itself. Term is a sound product for the right season. The trap is treating term as a permanent solution when it was never designed to be one, and failing to make decisions about permanent coverage while the window is still open. There's a reality about life insurance that doesn't get discussed enough. Your access to affordable coverage is not static. It changes with every year that passes and every health event that occurs. At 50, a healthy person has access to a wide range of products at competitive rates. At 60, that range narrows a little bit. At 65, it narrows further. At 70, the options that remain may be limited to guaranteed issue products, which carry waiting periods, lower face amounts, and higher premiums per dollar of coverage. None of this is meant to alarm you. It's simply how insurance underwriting works, and understanding it is the difference between making a proactive decision and reacting to a situation where your choices are already limited. The cost of waiting is real, and it compounds over time in two directions simultaneously. Premiums increase as you age, and the availability of certain products decreases as health changes accumulate. If there's one framework I want you to leave this presentation with, it's this. In life insurance planning, age and health are not background information. They are the primary variables that determine what you can get, what it will cost, and how long you have to make a decision. Age affects premium directly and predictably. Life insurance is priced on mortality risk, and mortality risk increases with age. A final expense policy purchased at 58 will almost always carry a lower monthly premium than the same policy purchased at 68, often meaningfully lower, for the same face amount and the same carrier. Health affects both price and access. Certain health conditions don't necessarily disqualify you from coverage, but they change what products are available. An experienced agent who works with multiple carriers can often find options for health profiles that a less experienced agent might assume are uninsurable. The right time to evaluate your options is when you have the most of them. I want to spend a moment on something that doesn't get enough attention in these conversations. Who you work with matters as much as what you buy. Life insurance is a long-term relationship. The policy you put in place today may be enforced for 20, 30, or 40 years. During that time, your life will change, your health will change, your family situation will change. And the person you worked with to establish that coverage is the person you'll need to call when those changes happen. An independent agent, someone who isn't captive to a single carrier, can give you the ability to compare products across the market and find the one that genuinely fits your situation. Independent agents have relationships with multiple carriers, which means they can advocate for you across a wider range of options. Experience matters enormously in this space. Final expense underwriting requires knowledge of which carriers are favorable for specific health profiles, knowledge that comes from years of placing policies. And choose an agent who will still be there, someone with an established practice, a track record, and a genuine commitment to the clients that they serve. Thank you for spending time with me today. My goal in every video I produce is to give you the kind of clear, honest information that makes your decisions easier, not to push you towards a product, but to make sure you understand your options well enough to make the right choice for your family. If what we covered today resonates with you, if you're thinking about a term policy that's expiring or a gap in your coverage you haven't addressed, or whether final expense might be the right next step, I'd encourage you to reach out. You can call or text me directly, 702-605-6038, or simply text FEX to that same number, and I'll follow up personally. Every situation is different, and I'm not here to give you a one-size answer. I'm here to help you figure out the right one for you. I'm Sean Matteson. I've been licensed since 2006, and I will be here when you're ready. I hope this video was helpful. This stuff really matters for your future, and I want to make sure you get it right. Hit subscribe, check out these videos right here, and if you have any other questions, just text LIFE to 702-605-6038. I've also linked a lot of resources in the video description and other ways you can get a hold of me.